Now, today's conversation comes from, as a lot of these episodes do, a lot of these sessions that we have revolve around conversations that I've had or representatives of our company have had with federal employees just like you. So I know that these topics are relevant because others are going through it. And this is one that we get a lot of, but it came from a recent conversation that I had with a federal government employee when it comes to retirement and when it comes to having income in retirement, and then when it comes to also utilizing or setting up their TSP properly. And what do I mean, and where am I getting at here, or where are we going to go? And it talks about taxes. And, are you creating a tax bomb for yourself when it comes to leaving money to your family? And what are your options? And this conversation, again, that I had with a federal government employee revolved around needing enough when it comes to their income in retirement, but then what to do with the remaining money. I'll paint the picture here. Say you're going to retire, and during the retirement scenario, during your retirement review, and by the way, that's one of the ways in which we can go over these things with you, is by doing a full benefits and retirement review. If that's something you're interested in, go to our website, www.federalretirementshow.com. Fill out the form, and we'll be in touch, and we can do a full benefits and retirement review for you. But just saying, and talking about this particular person, we were going over that review, doing all that was needed to be done to outline what their pension's going to look like, what their future Social Security income is going to look like, what their TSP is going to be doing for them, both now and in the future, what their FEGLI look like, going over the survivor benefit options and everything. And when we got to the retirement income scenario, we went over the pension, we went over Social Security, and this person was going to need to utilize a little bit of their TSP to generate another guaranteed lifetime income for themselves to get to a level that they're going to be comfortable with. And you've heard us talk about this before, that if you need income in retirement, or to back up a second, what we would normally recommend and look at is making sure you have at least a base level of guaranteed lifetime income to cover all of your expenses and then some, but to make sure that everything is going to be paid for, your bills, your living expenses, all of that with guaranteed lifetime income. That way there's no worry, there's no stress, there's that peace of mind. Well, that's what we were talking about with this person, but they're going to have a significant amount of TSP and other investments available or just sitting there, even after generating all the income that they need. They were not going to utilize all of the assets that they had to generate the lifetime income that's needed. This is a good position to be in, as you might think. Hey, I've got too much money. I've got enough money left over. I'm not sure what to do with it. What do I do? Well, they did say that they wanted to leave a legacy. They want to leave their TSP and other investments, other retirement savings accounts that they had, to their loved ones, spouse, kids, grandkids, etc. And we start looking at this, and all of those assets, all of the monies that they've been saving up have been in pre-tax accounts, basically the traditional portion of your TSP. The money has not been taxed yet. So all the money that you've put in, and if this was you in this scenario, all the money you put in has not yet been taxed, has accumulated interest or earned interest based on the performance of whatever the investment vehicle is. And in the end, every dollar when it comes out is going to be taxable or taxed as ordinary income. But if the thought for this federal employee was, look, I'm going to have all the income I need and then some, I'm going to have a good problem, which is too much money in retirement. Am I creating a tax bomb for myself or my loved ones if all that money is in a traditional type account, right? A pre-tax account. And depends on the way you think of it. I would say yes. You're going to create kind of a tax problem for either yourself or somebody down the road if you need to access that money. Why? Because everything's going to be taxed. It's going to be taxed as ordinary income. Now, there's two things we can't avoid, right? Death and taxes. Somebody's going to pay that tax. So the idea here was this federal employee is going to have more than enough money. They're going to have some left over in their TSP and other investments, and they want to create and leave a legacy. There's a couple things I want to discuss here with you. Now, number one, what do I mean by the tax problem? Well, again, All this is pre-tax dollars, is earned interest, accumulated interest, has had earnings, whatever the investment vehicle is. If it's TSP, let's say the funds went up, they earn interest over time. Well, when they want to take money out, every dollar is going to be taxed as ordinary income. So depending on your tax bracket, you're going to have to pay tax on whatever type of withdrawals you make from the account while you're alive. Let's say you're the retiree, you take a withdrawal out, you're going to owe tax on that entire amount. It's taxed as ordinary income. Same is true if you leave it to your spouse. If they start taking withdrawals, they're going to pay taxes on it. We can't avoid the taxes. What if it passed on to your beneficiaries, say your kids? Well, they're also going to owe tax on this, but if your traditional account got passed to them, it's now going to be considered an inherited IRA. And a non-spouse inherited IRA requires, now by new law, tax code, that they need to withdraw that entire account within a 10-year period. So if you have a significant balance in your TSP, yes, they will inherit that money, but they'll now be required to take all that money out within a 10-year period. And even if they took out incrementally, 1/10 every single year for 10 years, they're going to pay tax on that entire amount on top of any money that they've earned as far as income. That can bump them up into a higher tax bracket. They can end up paying more tax on all the money that they earned, not just the amount that they had to take out from the inherited IRA. So there could be a problem, not just for you, but if you want to leave a legacy to somebody else, you can be creating a problem for them.